Now, the whole goal with today's presentation is to make sure that people understand a bit more about Social Security, about Medicare, about investing, about generating retirement income, and about risk management. Those are the big focuses there. There'll be some other parts to this too. Now, depending on what you all tell me would be most valuable to you to get more detail on, our next class might be focused on something different. Maybe it'll be on the nuances of Social Security. Maybe it'll be on Medicare. Maybe it'll be on something else, right? But it depends on what matters most to you. So I depend on all of you to let me know, right? If you think that there's something you wish you went more in depth in, I'd love to hear it. So part of that email I'm going to send everybody is going to be asking for everybody's feedback on what they'd like to learn more about. Now, a couple of important disclosures. As much as we all hate disclosures and they kind of feel like a waste, I think it's important just for legal reasons. So all content that's included in this is for information purposes only. In order for me as a certified financial planner to give you advice, I'd actually have to get to know you a little bit, talk to you about your finances, talk to you about your risk tolerance. So everything you see here today should not be the basis for any financial decision. If you make one as a result of this, it's on you. Okay. Nothing here is included is considered a projection of your future or current performance or an indication of future results. Any opinions are expressed solely by Progress Wealth Management and our editorial staff. Information contained in this material has been derived from sources that are believed to be reliable, but are not guaranteed to be accurate and complete. Now, needless to say, I believe all this material is up to date and accurate and complete, but for legal reasons, I'm not guaranteeing that. All right. I think that's an important distinction. Now, here's our table of contents here today. Now, first, because none of you know me, none of you understand my background, why would you trust me without knowing a little bit about me and my company? We're going to first tell you a bit about us so that you know whether or not you believe you can trust us. From there, we're going to go into the problems that really most retirees encounter that hurt their ability to live a happy, full, and healthy retirement. We're going to talk about the most common mistakes that retirees make that are the big mistakes. Not the little ones, the big mistakes. And when I say big mistakes, I mean mistakes that could ruin your retirement. Mistakes you should be concerned with, that you put effort into avoiding. I'm going to talk a bit about our process at Progress Wealth Management for fixing these mistakes and making sure your retirement's put together correctly. I'm going to talk a bit about how to invest in retirement. We're going to talk about Medicare, tax mistakes, budgeting, risk management, and then from there, go through a little bit of a conclusion. Okay. So let's get started here. Now, Progress Wealth Management is a non-commissioned tax and financial planning firm. We're fiduciaries that specialize in taking the guesswork of helping retirees plan for their future. So we provide our clients with a team of professionals, and not a single professional that works here has less than 10 years of experience. Now, at Progress Wealth Management, we believe that designations and credentials matter. They prove that you don't just have a number of years in your role, but you actually know what you're talking about. Right? Both are really important. So every single person that works here is at least a certified financial planner, a CPA, an enrolled agent, right? So basically everyone has had some level of experience that proves that they are able to help our clients effectively. Now, me, myself, I've worked at some of the biggest names in finance and accounting. I worked at PricewaterhouseCoopers, helping corporate executives better plan for their financial future. I worked as one of the senior financial planners at Fisher Investments, where I only worked with clients who had 10 million or up. I've worked at a number of other firms, and all of these have been in senior, more focused roles on financial planning. And almost every role has been focused on helping retirees with Social Security, financial planning, tax reduction, Medicare, so on and so forth. Now, if anybody's looking for extra advice, I'm not a big salesy guy, but if people feel like they want more detail after this and they don't want to sit through an hour-long masterclass, you can schedule a free consultation. It should be in all of your emails. And have direct access to my calendar. You just click on that, click talk to an advisor. Happy to talk. Now, moving on to the most common problems that get in the way of affording a happy retirement. And the number one, and this is the most obvious one, is insufficient savings. But it's not very obvious because most retirees don't know how much money they need to have saved in order to retire comfortably. They think, I'm tired of working, so I'm just going to retire. The problem with that is, what if you don't have enough? Right? What if you're a little short? And all of a sudden you find yourself running out of money in your 80s. Either A, you'll be forced to be homeless, B, you'll move into a Medicaid facility, or C, you'll move in with your kids. All three of those options are terrible. And I haven't met a single retiree that'd be excited about any of those. right? So it's important to make sure before you retire that you've done the math, right? There are a lot of free tools out there that can help you do the math. Personal Capital's mobile application is free. One of their sales guys will try to call you, so just tell them no. But they do have a free mobile application that does a really good job at helping you figure out your own retirement plan. Next big one is healthcare costs. Medicare is the worst health insurance money can buy. And it's the only one that's available to retirees in the United States that is not permitted to drop you for healthcare related reasons. So Medicare has a lot of problems and gaps in coverage. And the biggest one is that for preventative healthcare, you owe 20% of all your preventative healthcare costs out of pocket. And you may not think that that's that big of a deal, but you have to remember, if you have to have some sort of surgery to help prevent you from getting a heart attack, if you have to have some sort of medication that's incredibly expensive to help you avoid going into a diabetic coma, right? These are all considered preventative healthcare costs, and these can get incredibly expensive. I've actually worked with a client who had $1 million surgery. Medicare covered 80% of it, and they were required to cover 20% out of pocket. If you had a $200,000 unexpected bill, you better bet that would impact your retirement, right? Another big one is inflation. Everybody should know the word inflation because of last year. Healthcare costs, food, housing, everything went up in cost a lot. And that's called inflation. And if you don't plan for inflation by being too conservative with your investments, because there is such a thing, inflation could kill your retirement. So we need to try to grow your money, even when you're retired, unless you are filthy rich. And even then, why leave money on the table? Let's still try to grow it anyways, right? A little more for the grandkids and the kids isn't going to be a bad thing. Another big one is long-term care expenses. If you move into a retirement facility and you can't afford it, it's a quick way to go through a few $100,000, especially if you end up getting dementia or some terrible problem later on. It's important to plan for that, even though it's uncomfortable and we hope it doesn't happen. And everybody says, I'll just have a long walk out into the woods, but they never do it because that's really, really not something anyone wants to do. Never happens. So it just ends up becoming a burden on your kids. And the fifth one is decreased Social Security benefits. Some people retire too early and they don't end up actually getting the full amount that's on their Social Security statement. You need to know how much you're actually going to get. So I don't need to make everybody feel scared based on this. These are the problems. I'm going to help you figure out how to avoid these. But these are really important. If you don't think about these and you don't plan for these, it could really hurt your retirement. Okay. So any questions so far on this stuff, anybody? And feel free to unmute yourself. You don't have to stay on mute if you don't want to. Gone. All right, let's move on here. So the most common mistakes that retirees make. Number one, not having a comprehensive retirement plan. Most people, when I say comprehensive retirement plan, they don't know what that means. They say, what do you mean by comprehensive plan? Well, it means figuring out how much risk you can really tolerate. When I say risk, I mean your risk of getting a lawsuit, not the markets going up and down, right? It means not actually having a good budget. It means not investing the right way. It means not thinking about Medicare. It means not thinking about taxes. It means not thinking about every part of your financial life and how they all work together. And that may seem a little complicated, but if you forget one piece, if you forget one ingredient in a recipe for a pie, does the pie turn out well? Mm-mm. If you forget the baking soda and muffins or the baking powder, are they going to taste good? Probably not. It's the same thing with retirement planning. Miss one piece and it can hurt everything. I already talked about failing to save enough for retirement. I already talked about inflation. I already talked about not paying off debt before you retire is really important too. And not because interest rates are really high. Most of you probably have an interest rate on your mortgage that's really low. It's basically free money, right? 2.5%, 3%. Stock market will do better than that. The math says so. Well, the reason why that's so important is that number one, it decreases your cash flows in retirement, meaning we don't depend on the stock market to do as well. Number two, it decreases your stress. If anybody here says they feel less stressed spending $6,000 than $4,000 a month in retirement, you're lying. Because spending less always makes all of us feel better if our bills are lower. Underestimating healthcare costs. A lot of people think, you know what, I'm in great health. I'll always be in great health. I'm just not going to wake up someday, right? I don't mean to be dark. I don't mean to be crude or overly forthright. Apologize if I come off that way. But the point of the matter being is we need to plan for what could happen, not what we expect to happen. Because what could happen is what could bankrupt you. We want to prepare for that. Taking on too much investment risk. Some retirees think they want to play the stock market with money they can't afford to live without, and they're not experts at it. Maybe they listen to Jim Cramer or the Motley Fool they read all the time. Fun fact, Jim Cramer's average annual rate of return is barely 4%, and he's made some terrible calls. So if you're a fan of Jim Cramer, see it as entertainment. That's what he calls himself, an entertainer, not a financial advisor. Right? Not diversifying investments enough. I've had quite a few retirees keep most of their money in their company stock. If anybody here is a Boeing employee, you probably have a healthy chunk in there. If you keep too much in your company stock and your pension's based on your company and your investments, you're taking a lot of risk. And retirement's supposed to be somewhat conservative, not too much, but somewhat. Right? Taking Social Security too early, spending too much too soon, and not considering long-term care expenses. We'll talk a little more about these later on, but these are the top 10 mistakes. Okay. Now, what do we believe is a perfectly managed retirement plan? Well, from Progress Wealth Management's point of view, retirement planning is a function of 5 different really important areas. The most important one is to keep things simple. We overcomplicate things where it doesn't actually end up having too much of a benefit, right? Keeping things simple, keeping things conservative, being frugal, learning to live a happy life without having to spend all the money in the world, right? That's the most important part of any retirement plan. Now, it's important to spend as well because life's short. And needless to say, if we can enjoy life a little more today, that's great. But we don't want to be less than prudent about it. Just because you might not be working, you've saved for all these years doesn't mean we should spend all the money, right? We need to make sure you're protected. Protecting your retirement plan by making sure you have typically umbrella liability insurance. You're keeping money in retirement accounts because it's against the law in most states to sue people for money that's in retirement accounts like IRAs and 401ks and pensions. Keeping money in those kinds of accounts protects you better. We need to make sure you invest because bank accounts don't pay anything these days, and annuities also don't pay much, lots of fees. Right? And lastly, we need to prepare for everything that could happen. And this can be simpler, I promise. It's not that complicated once you figure it out. But preparing for what could happen is really important. Now, for our clients, we typically start off by first trying to focus on avoiding the big mistakes. And the big mistakes in everyone's financial life are the ones that could get in the way of you living a happy life, you being healthy, you being able to afford to stay financially independent. These are big mistakes that we need to try to avoid. And what are these kind of big mistakes, right? Well, number one, spending too much, more than you can afford. That's a really big mistake. And that seems obvious, but so many people do it. Number two, a lot of people invest really poorly. We want to make sure we avoid that. We want to make sure you've got enough insurance, right? We want to make sure you're protecting yourself. These are really important. Now, how would we go about doing this? Well, the first step is to look at how much money you have. Look at what kinds of income sources you have. Look at what retirement goals you have. You might say, Blaine, I want to travel the world. Or Blaine, I'm not a big traveler. Being on a plane for 20 hours isn't my cup of tea. I just want to spend time with family. I've spent so many hours and years working. I'm tired of that. I just miss my grandkids or my kids or my friends, right? Whatever your goals may be, that's the most important part of all of this because I'm trying to make you live a happier life, right? And then from there, we'd figure out what kind of budget you need to live that life. And we'd figure out how you're going to plan for healthcare expenses. Now, some really important things for everybody to remember are every single year, we're supposed to be reviewing your Medicare because there's certain things that cover the stuff that Medicare doesn't cover that are called supplement plans or advantage plans. And these can change year to year, just like your health can. And sometimes you have to change the supplement plan you own or the Part D plan as your health changes. So it's important to monitor that stuff. And it's really easy to monitor. eHealthMedicare.com. If you want to get into the weeds, you can do that on your own for free. You don't need a professional to help you. You just have to be prepared to read some stuff. Now, once we've figured out what kind of risks you have and what kind of goals you have, from there we'd figure out a plan. that'll help you fix the big mistakes and make sure you don't outlive your money. I would show you a bunch of forecasts and the math, and I'd make sure you didn't have to overcomplicate anything. We try to keep things simple. But the point of the matter being is we'd give you some options and help you figure out which option we think is best, but you're the one who's still in the driver's seat saying which one you want. And the last really important step is make sure you're being tax smart, because we don't want a big tax bomb later in life. And we want to make sure you're being conservative as well, right? We want you to estimate on the high side for how much things are going to cost. We're going to estimate on the low side of what you expect your returns are going to be, right? Now, there are little mistakes we can avoid as well. A lot of people here probably have a lot of money in 401ks and IRAs. And you may not be familiar with this, but there's this thing called a required minimum distribution that'll start in your 70s. You're going to have to take out about 5% of the account by the time, I believe, you're about 73. And 5% is not a small amount of money. I mean, if you're 62 right now, you might have twice as much by the time you're 72. It's not at all unrealistic. And all of a sudden, 5% could be way more than you want to withdraw. And why is that a problem? Well, because it'll push you into a really high tax bracket. So it's important to plan for that. It's important also to make sure you review your asset protection plan annually. If you get into one car crash and they find you at fault, that's a big deal, because they could sue you for money that's in your bank account. They could sue you for money that's in your individual brokerage account. It's called your non-retirement. They can sue you for a lot of stuff. You want to make sure that they have less things they can sue you for, and we're protecting you better. And then also want to talk about your healthcare plan as well, what you're doing to make sure your healthcare costs are lower. Now, how to invest for retirement. Now, not everybody here is within 10 years of retirement. A couple people here are within 20. So it's important to go through a lot of stuff. And some of this stuff may be a reminder for you. So by all means, I don't mean to make your eyes glaze over, but still important to talk about. Most important thing for everyone here to do when you're thinking about investing for retirement is to start early. And everybody's heard this probably at least once, but the reality is, if you only save $200 a month starting at the age of 25, all the way through 65, assuming a 7% rate of return, you'll have north of 1.5 million bucks by the time you're 65. You bump that up to 300, it's almost 2 million. 500, even more, right? The earlier you start, the more money you'll have in retirement. Just by waiting till you're 35 to start saving for retirement, saving $200 a month, only average, I believe it's about 650,000 by the time you're 65. And in today's day and age, that may not be enough, right? The next step is making sure your portfolio is diversified. And that's another thing most people have heard at least once. And when I say diversified, I don't mean between 5 different stocks. Typically, this is diversified among large companies in the United States, like the S&P 500. Many of you may have heard of that. 500 largest companies in the United States. We're going to be investing in small companies because they typically do better during bull markets. So you can expect to grow your money a little faster. Invest overseas as well, because the United States, it's not the place it used to be. And most forecasts are forecasting other countries like India to outpace the United States and eventually be a much larger economy. Same thing with China. China's expected to in the next couple of years. The United States is not expected to always be the top performing economy like it once was, right? Consider tax implications as well. Mutual funds. So Vanguard is one company probably everybody here has heard about at least once. And fun fact, in 2019, Vanguard was sued for a ton of money because of mismanagement of a target date retirement fund. If anybody has a 401k here, you're probably invested in one of those. And the main reason why they were sued is because they sent out a massive tax bill to everyone who owned it in a non-retirement account. So we have to remember that the investments you have will sometimes generate taxes, and mutual funds send out more than almost any of them. So it's important to prepare for that. It's important to make sure that the investment strategy you're in, you're planning for the tax implications of whatever strategy you choose, right? Now, it's important also to contribute regularly to your retirement account. Some people say, and I'll contribute once a year. A lot of self-employed people I've worked with will say, Blaine, once a year after I pay my taxes, then I'll put a big contribution to my retirement account. I'll know how much I have to deal with. Perfectly fine. But as long as you do it regularly, it's systematic. You're not thinking about the highs and the lows, and you're trying to time it. Try to make sure it's monthly if you can, right out of your paycheck. Learn to live with that monthly amount going into the retirement account. So that way you don't think about it, and that way We can forecast a little easier. Really important thing as well, most retirees that I've worked with, they don't like the stock market going up and down, especially if your life savings and your ability to live a happy life depends on the stock market. And I don't necessarily blame them. But we want to make sure that you can sleep well in retirement if you keep yourself up at night. Because the stock market goes up and down, it means you're probably a little bit too risky. But we also don't want you to put all your money into an annuity either, because that doesn't grow very quickly. Right? Probably somewhere in between the two. Right? And then lastly, plan for inflation. We need to make sure that you're growing your money as quickly as we can, but as prudently as possible. Right? So now, how does this all work? Now, I've gone over a couple of these already. Just a couple of these I want to highlight. Not considering fees. That's a really important one. And if anybody here works with a financial advisor already, there are a lot of great advisors out there. And if you trust yours, that's fantastic. But I think it's important to go in with your eyes open no matter who you are. So you know what kind of fees you're paying. Because I've talked to not a small number of clients that pay 2.5% or 3% of their investments in fees. And what that means is you'll retire. At the end of your retirement, you might have half as much as a result. It's a big deal, right? Half as much growth. So that's really important. Now, it's also important to have a long-term perspective. If anybody here likes to watch the news, you, like a lot of other people, are feeling a little nervous lately. Is it a good time to be invested or is it not? If it's a bad time to be invested, well, then you might end up getting out of the markets, but never get back in. And that's a much bigger deal. In the long run of things, betting on humanity to continue having children and working hard is a lot less risky than the markets going up and down for a couple months. Right? Just betting that humanity is going to keep working, because if we stop working, we'll all starve. That's not that big of a risk. Short term, things might be a little volatile. Long term, well, things typically grow. Now, what are some remedies here? So at Progress Wealth Management, we believe in individual stock portfolios that are well diversified. We create our clients their own index funds with individual stocks. And the main reason is because of the tax savings. It's a lot easier to do something called tax loss harvesting, for anybody who knows what that means, with individual stocks than it is ETFs. But if you don't like individual stocks, exchange traded funds are a great option. They're very tax efficient. They're very low cost and simple, right? They do the job they're supposed to do. Now, mutual funds can be great as well, as long as they're low cost. There's a lot of really expensive ones out there, and it's important to pay attention to fees. So we're big fans of Vanguard mutual funds and Schwab. Even though Vanguard had that hiccup, their mutual funds still are very well managed. We're big fans of them. If your advisor is not using any of these and they're using something more similar, maybe an American fund or a Lazard fund, probably should pay attention to that. Now, if anybody here wants to look at the fees, because I did talk about that for a moment, this is a great example. If anybody recommends you a mutual fund, Google the name of it. Expense ratio right here is how much will come out of the performance. So if the expense ratio was 0.72 and it goes up 10%, you only get to keep 9.28%. The rest goes in fees to the mutual fund company, in addition to whatever your advisor charges. And there's a big commission up front as well, typically, to some advisors that are paid on commission, right? We are not. Just keep that in mind. But this is a big commission. And that means that if you put $100,000 in there, you'd pay $5,750 in fees just to get a recommendation. I don't think that's fair, right? So bring that up just to make sure everyone goes out with their eyes open. Important thing to think about. Now, Medicare is going to be the next thing we talk about here. Now, for anybody here who's 65 or older, if you're still working at a company that has over 20 employees, you don't have to sign up for Medicare yet. Sign up for Medicare as soon as you retire. For everybody else, the second you turn 65, you have to sign up for Medicare. If you don't, you'll be charged a penalty. So the biggest mistake that anyone can make is not signing up for Medicare in the initial enrollment period. And fun fact, that penalty never goes away. You'll be paying more for Medicare until the day that you stop paying for Medicare, meaning the day your retirement's over, right? Now, another really important thing is there are a lot of salespeople. The second you turn 65, you're going to start getting phone calls from insurance salespeople out of the blue, trying to sell you some sort of Medicare insurance coverage. And most of them, if not all of them, do not have your best interest at heart. right? So before you make a decision on what kind of Medicare supplement plan or Medicare Advantage plan you should be signing up for, consider all your options. Talk to someone who's non-commissioned. Ask your financial planner, which one should you pick? Now, not understanding the difference between Medicare and Medicaid, you're going to sign up for Medicare if you're disabled, and this is as per Social Security, or if you're 65 or older. Right? And lastly, not considering the cost of the supplement insurance and not reviewing and updating your Medicare coverage annually. Now, how do you sign up for Medicare? That's a really important other point here. You can walk right into a Social Security office, same place you'd go to sign up for Social Security, and sign up for Medicare at the exact same time. Alternatively, you can dial 1-800-MEDICARE, and you'll get in contact with people who work with retirees and helping them sign up for Medicare. And these are people that are employed by the government, so you don't have to worry about talking to some sort of salesperson. And most all of them that I've talked to in the past all know their stuff. They're really nice people, right? Now, a couple of these I already talked about already. Enroll within the first 3 months after you turn 65. I say the first day you turn 65 or the first week, just because people forget, right? Now you have to research and compare all coverage options. Now, most people, just about everybody, is forced to sign up for Part A. This covers surgeries. This covers emergencies. Part B covers preventative care. Part C is a Medicare Advantage plan. Not everybody signs up for Part C. And then Part D, D stands for drugs. This covers pharmaceuticals. So if you have any expensive pharmaceuticals, or if you may ever need one in the future, you should probably sign up for Part D at 65 as well, right? Because eventually you may need them and it's not that expensive. Right? Now, whenever we're trying to figure out how to cover all the stuff Medicare doesn't cover, eHealth insurance, eHealth Medicare Insurance.com is a great place to go, or you can talk to someone who can help you make the decision so you don't have to do all the research on your own, because it's hard to figure this kind of stuff out. Right? But I'd talk to someone who's non-commissioned and a professional. Okay. Now, moving on to tax mistakes. I've gone over a lot so far. I've probably made some people's eyes glaze over, and I apologize for that if I have. I've gone over a lot. What questions do people have so far? Feel free to unmute yourself. I'm happy to answer all of them. Anybody?
Recording in progress.
Anybody? All right. All right. So what are the most common tax mistakes by retirees? So the most common tax mistakes, and the most common one of all of them, is not taking your required minimum distribution. And when I say your required minimum distribution, when you turn 73, you're going to have to start taking out 5% of the account, of your pre-tax accounts. Okay, your pre-tax accounts. If you don't take that, the IRS, they're mean. They'll charge you whatever you're supposed to take, 50% of that. So let's say, for example, if you have $1 million in IRAs and 401ks and you're retired and you're supposed to take 50 grand out and you fail to, it's a $25,000 penalty. Ouch. Ouch. That's a penalty you never forget, ever, ever, ever. So don't forget that. If you do forget it, you can write a letter to them. And I've heard that on occasion they can be kind. They may forgive you once, but if you forget it twice, they probably won't. So don't forget it. Okay. Failing to account for changes in your tax bracket. That's another really important one. So just for example, Medicare, as we talked about just a couple slides ago, Medicare is priced progressively. The more money you make, the more it costs. And most people don't realize that. If in retirement, you're making over $170,000 a year between Social Security and pension income and distributions from retirement accounts and all that, your Medicare will go up in cost. It's based on something called your modified adjusted gross income. The point of the matter being is it's important to plan for these kinds of changes in tax bracket and cost of coverage. If you don't, it can get pretty expensive for Medicare. All right. I heard somebody go off mute. Anybody have a question so far? Amy or Ann? All right. So now, not considering the tax implications when you're taking money out of your retirement plan. So most people may know this. When you take money out of a pre-tax account, you pay tax on it. You have to pay tax at something called your ordinary income tax rate. And this is going to be on your federal tax bill and your state tax bill. So point being is, the more you take out of that, typically the higher the tax rate you're going to pay, right? Social Security, for most people, you're going to pay tax on too, right? Depending on your income level, it could be anywhere from 0% taxes, if you're really good at manipulating it, to potentially as much as 85% of your Social Security you may have to pay tax on at the same tax rate you do at your income right now, working, right? So it's important to plan for that. Roth IRAs are retirees' favorite kind of account. And most of you may know why. You don't pay taxes on any withdrawal, but there is a couple caveats here. You got to be careful for the hiccups and the speed bumps. And what are those? Well, if you put money in there within 5 years before you take it out, you have to pay tax on growth. And if you take money out before 59 and a half, you have to pay tax on growth and a 10% penalty, right? So most financial planners, for that reason, will say, hey, let's not touch the Roth IRAs until you're in your 80s, maybe. Right? Maybe 70s, depending on your life expectancy. And we want to try to get you as much tax-free growth as possible. Now, not properly reporting taxable income from pensions and annuities. Now, for the people who are TurboTax lovers here, I've seen not a small number of mistakes on TurboTax. You got to be careful. Pensions, you're going to pay tax on it just like you would a normal salary, right? Not including FICA taxes, but still, just income taxes. And annuities, you got to pay tax on growth, right? And the growth comes out first, not your contributions. So that's why early on in retirement, those annuities are extra tax heavy. Got to be careful, right? And then lastly, not taking advantage of tax deductions and credits for retirees. We're going to talk about these here in just a second. All right. Does anyone need a quick break for a glass of water or a cup of coffee? Or any questions? This stuff gets a little dry. I know. I'm trying to keep it lighthearted though. Anyone? All right. So how to avoid these tax mistakes? So required minimum distributions. You're going to get forms in the mail. Make sure you give them to your tax accountant, right? So if you have your IRA at Schwab or Fidelity, they'll send you those forms every single year. Make sure you get every form they send you directly to your tax accountant. You'll make sure you avoid any mistakes with RMDs, right? Consider changes in your tax bracket, and as well as your sources of income when you're estimating your taxable income in retirement. Plan your withdrawals carefully. So when I say plan your withdrawals carefully, it's important to try to target some sort of tax bracket in retirement. And this can get a little complicated, but it's completely possible for most people to plan to try to be in anywhere from the 12% tax bracket to possibly maybe the 22% if you're extra high income and you've saved really well. By planning out your withdrawals, it's easier to figure out how to stay in these tax brackets. Now, what do I mean by that? Well, just imagine this. Imagine you've got $1 million in an IRA, $1 million in a non-retirement account, and you need to take out $100,000 a year in addition to Social Security. You want to travel the world, so you're going to be a big spender. So how would that end up working, right? Well, if we're trying to keep your tax bracket low and you're married filing jointly, the top of the 12% tax bracket these days is about $86,000. So we might say, you know what, maybe we'll take out some long-term capital gains from your non-retirement account. Maybe we'll end up taking out a good chunk from your pre-tax accounts. Okay. Yeah, SJ, I'm more than happy to go over Medicare and term life as well. right? Long-term care, that gets pretty complicated, and not everybody needs it. It's really expensive. So if it's okay with you, SJ, would you mind talking to me a little bit after, just one-on-one? Happy to answer all your questions a little more specifically on that kind of stuff. Are you okay with that? Okay, great. So plan your withdrawals carefully. So by trying to make it so you don't take out more than $86,000 a year out of pre-tax accounts, right? Then your income will end up staying under the $86,000 mark and keep you at the 12% tax bracket. And long-term capital gains, by you keeping those, taking those out of your non-retirement account, you can keep your tax rate on those withdrawals at 15%. Long story short, not hard for you to try to keep your tax rate low, even if you end up taking out a big amount of money out of these accounts every year. Okay. Now, take advantage of tax deductions and credits for retirees, such as those for medical expenses, charitable donations, to reduce your taxable income and lower your tax bill. Now, if anybody here has a large amount of medical expenses, above 2% of what your income is for the year, it's called your adjusted gross income, you can consider that as a deduction, right? Also, for anybody who's closer to retirement and you're still not on Medicare, you might be able to use something called a flexible spending account, FSA, to help pay for medical expenses. Get a big deduction, lower your income in the IRS's eyes, even if you take the standard deduction. It's great, right? And this can also help you lower your taxable income and lower your tax bill. And you can just reimburse yourself with that account, even if you didn't use it when you had the medical cost. So all sorts of things you can use to try to lower your tax bill. Now, what are some of the really exciting, rarely known tax opportunities? My favorite one is Roth conversions. And a lot of my clients get excited when they first hear about this, because required minimum distributions, if anybody here is extra wealthy and you've got a lot of money in an IRA and you've got a pension, you don't have a lot of control over what your taxes are going to be if you're already past your required minimum distribution age. Not a lot of control. You do have a little control. But if you're not there yet, we should start preparing for battle. What do I mean by that? Well, Roth conversions, that's our main piece of armor for what required minimum distributions will be. And how they work is, every single year, you take a little piece of how much money you have in IRAs and 401ks, and you say, hey, Charles Schwab, or hey, Fidelity, I want to take that money and I want to convert it into a Roth. It's not considered a contribution. It's considered a conversion. And the benefit of that is, as a result of you making that conversion, that money grows tax-free the rest of your life. And you can prepay your taxes on it at the rate that you want to. So long story short, that helps you to take control over your future tax situation. It's nice to have an option to help you prepare for what could be a tax bomb later on. The next one is a qualified charitable distribution. For anybody here who is charitably inclined like myself, for anybody here who likes to tithe to their religious institution, for anybody here who has any sort of charity that they love and they really believe in, and they want to be charitable no matter what when they're retired. Well, if you could be charitable and give to the charity of choice and not have to pay as much taxes, I consider that a win, right? Now, what's really great about qualified charitable distributions is when you do get to 73, and you start taking these required minimum distributions, these take the place of that distribution. So you can actually make it directly to the charity. And as a result, you don't have to take two distributions, one to give to the charity and one for your required minimum distribution. It's a nice deal, right? So it makes things a lot easier. We already talked a little bit about tax smart withdrawals. Now, annual gifting, for anybody here who has 3 million or more, completely feasible. Someday, if you invest aggressively, you could be worth a lot of money in 20 or plus years. So much so, the IRS may charge you state taxes, especially if you live in Oregon or the state of Washington. And as a result, it's important to make sure you give. You don't just leave an inheritance for your loved ones. You make gifting annual. And you can end up putting money into 529s for your grandchildren if you have any. You can make Roth contributions for your children if their income is below a certain limit, right? You could even pay off debt for people. Or if you have any family members that are in the hospital, you can make a gift directly to the hospital. as much as you need to pay the whole hospital bill or their whole college and not have to worry about the gifting limit. So you could pay $40,000 if you wanted to. Get it out of your estate. The point of all this is, and as much as no one loves to say, Blaine, my retirement plan isn't supposed to be about giving, it's supposed to be about me having fun. If you could leave more after taxes to your family rather than less, I think you'd prefer that, right? We don't want to leave an inheritance for the IRS. We want to leave an inheritance for your loved ones. And the last piece of this is your health savings accounts. Now, needless to say, there's more than these 5, but these are the most common ones that I see people miss out on. Health savings accounts, I see a lot of people use them early in retirement, and that's such a huge mistake. Just think about what you could do if you ended up having a health savings account that you just didn't touch until your 80s, rather than use it all in your 60s. Now, for those of you who don't know what a health savings account is, if you're on a high deductible health insurance plan, you can put money into one. It's a tax deduction. Then you can invest in that account, and it can grow and grow and grow, just like a Roth IRA. And it grows tax-free, so long as you use it on healthcare-related stuff. And I say stuff to make it sound vague because it is vague. It's literally almost anything related to your health and well-being. I have a client who had a doctor's note recommending they exercise, and they end up doing some sort of strength training in order to help fend off osteoporosis. And they got the doctor's note to say that they agree to let them get an at-home gym. It was HSA qualified. Tax-free growth, right? So literally anything related to your health and well-being. Now, by not touching these in your 60s, maybe wait to your 70s or even your 80s, you have an extra 20 years possibly of tax-free growth. You could have literally 3 times as much to use on healthcare related expenses. That makes healthcare and retirement very affordable. Okay. So any questions on these tax opportunities? I know tax is the most complicated section in this class, and I typically get a couple blank stares at me whenever whenever I go over this. Anybody feeling confused? All right, Ann, yeah, I'm ready for your question. What can I do for you?
Thank you. Going back to the question of IRAs,
Yeah.
How does an IRA CD work? Specifically, if they're short term, when they mature, are the earnings on an IRA CD, and you reinvest in another IRA CD, are those earnings taken away from your annual limit of the year that you earn it? Or do you still? Okay.
Not at all. Completely tax-free earnings. The money stays in the IRA. The only time you pay taxes on investments that are in an IRA is when you take money out of it, right?
Question's a little different. You know, there's an annual limit on how much you can put into an IRA.
Yeah, $7,500 if you're over 50 right now.
Right. So $7,000 for me. If my CD matures and the earnings on that CD are really good, say like $200.
Yeah.
When the year that I earn that $200 of interest, am I still able to put in another 7,000, or can I only put in 6,800 because of the 200 earnings?
The earnings will not be considered a contribution.
All right. Thank you.
You're welcome.
That's exactly what I needed to ask.
Absolutely.
Earnings are considered a contribution. That's terrific. Thank you.
Absolutely. And real quick as well, CDs these days, I actually know a couple money market funds that are paying 4.3, 4.4% after expenses. If your CD is not paying as much as 4.3, 4.4, probably a good idea to look at some other options. I've only seen a couple of CDs that pay 4% even these days.
I'm looking at 2 right now, IRA CDs, because I haven't made contributions for 2022. I'm looking at a 4.6, but I'm trying to find the fine print, and a 4.4.
Look at something called the expense ratio. If you see the name of actually, no, you're looking at CDs. There's no expense ratio. If you're looking at any money market funds, you might want to look at the expense ratio first as well.
Just going to CDs. Thank you.
You're welcome. You're welcome. I see another hand up. What can I do for you? Oh, and actually, no, never mind. I don't see another hand up as a question. So I got a question from SJ. I said, how to sign up for a health savings account, and what do you do if there's money left in there when you die? So SJ, and if don't want to unmute yourself, that's no problem. But the big question for you is, number one, are you still working? And number two, are you on a high deductible health insurance plan through your employer? Okay, so SJ says, yes, he's still working, and no, not on the high deductible plan. All right, so health savings accounts you have access to if you're on a high deductible health insurance plan. Now, what does that mean? It means that out of pocket, you're going to pay at least $4,500 as a deductible before your health insurance kicks in, right? So the first $4,500 in healthcare expenses, you've got to pay out of pocket, not cheap, right? But the main benefit of these is that if you're in a really high tax bracket, right? Let's say, for example, you are paying taxes at 39%, highest tax bracket in the United States. And by putting $7,200 into an HSA, you end up saving yourself more than the difference between high deductible and low deductible, right? That could end up actually making sense for you, even if you expect to have some high healthcare costs. So just for example, if you saved $4,000 in taxes or $3,000 in taxes by putting money to an HSA, what's the difference between low and high? Not a lot, right? So in order to sign up for an HSA, you'd have to sign up for high deductible, and then you can contribute to them. Now, if you file taxes single, you could put up to $3,650 this year. You file taxes jointly, I believe it's $7,300, right? Now, what happens to the money when you die? Well, if you're married, your spouse can take over the HSA 100% themselves, right? And it'll be now in their name only rather than in both your names. And if you aren't married when you pass away, then I believe your children have to take all the money out and pay taxes on it, right? Not a great situation for the kids, but needless to say, this is for you too. It's not for them. Right. Does that answer your question, SJ, or anything else? Any other questions for me? All right, great. Any other questions? I see Jackie is unmuted. It's okay if you want to stay unmuted, Jackie, but any other questions for me for anybody? All right, moving on here. Now, budgeting. Now, budgeting is one thing most retirees hate to do. Because if you've never had a budget your whole life, why now? But it's really, really important because we want to make sure that with how much money you plan to spend every single year that you can afford it. And we want to have some sort of process. Just like all of you, if you were thrown into your job right now, you wouldn't have to think about it. You've done this job and you've been in this profession for probably not a small number of years. You wouldn't have to think about it. You've got your process. You know exactly what you need to do to be successful. It's really important to have that same approach with your budget and your retirement plan. You need to have a repeatable process if it's done correctly. Now, the way to build a budget is, first off, you list out your needs. When I say your needs, I mean your healthcare expenses, your housing expenses, your taxes, your insurance, if you have any debt, food. These are the things that are needs. These are things you can't live without. Then from there, track your spending just for a couple months. And track your spending for once. When I say once, I mean these are the things that make your retirement happy. Going on vacations, giving money to grandchildren, doing all sorts of fun things that you were looking forward to for all those years, right? It's really important to list out these two and get an idea of what your average spending is on the high side. And it's also important to list out what sources of dependable income that you have, as well as what kind of estimated income you can generate from your investments. When I say dependable income, I mean pensions and Social Security, sometimes annuities, things like this are more dependable income. And your estimated income from investments, well, this depends on your investment strategy. If you're too conservative, that could be a big problem. It could make it so your money won't last as long. If you're too aggressive, you might be forced to sell out when markets are really, really low. We don't want to do that either, right? But I'll talk more about how you can generate income from your investments on our next slide after this. Now, we have to also make sure you prioritize your expenses. So we'll make sure you prioritize your expenses based on the importance, and also look for areas where you can cut back if needed. If needed. Okay. Not everybody needs to, but sometimes we need to. It is what it is, right? Been frugal before, we'll be frugal again. Now, it's important to also regularly review your budget and adjust. I typically would want my clients to review it at least once a year, just to see if anything has changed. And typically, most financial planners have software that'll help you figure out your budget for you. It's very simple just to say, hey, looks like the last 3 months you've spent this much per month. That's either above or below what you're normally used to spending, right? So that way it doesn't require as much effort out of you. And this is really important because we want to make sure that your needs haven't changed so much that you can't afford your life. And it's also important to know when you have to pivot. Because if you don't know when you have to pivot, then eventually you'll just keep overspending. And that can really hurt how long your money's going to last. Right? So needs and wants, and just figuring out your average monthly spending. That's really the gist of all this slide here. Now, many of you may have heard of the 4% withdrawal rule, but many people don't understand it. They don't understand what it means and why and how it works. So let's say, for example, you just retired. You're in year 0 of retirement. You're 65, you just retired, you've got $2 million saved, and you're invested somewhat conservatively, so you expect somewhere right around about a 5% rate of return. So 5% of $2 million is $100,000 in investment returns per year. Now, in addition to Social Security, you need to withdraw about $84,000 a year in order to pay all your bills. That's the way that works, right? So you say, Blaine, I need to withdraw 84 grand. Well, 84,000 is just over 4% of $2 million, because 4% of 2 million, 80,000 bucks. So you take your 100,000 in growth, subtract your 84, and you're left with 2,016,000 at the end of the year, right? Nice how that works. The growth outpaced your withdrawal. But because inflation happens, and we need to be prepared for inflation, big mistake retirees make is not trying to grow their money. We can't be too conservative. The next year, you withdraw 84,000. Next year, you withdraw 85 and 86, and then 87 and 88, 90, so on and so forth. We want to make sure that your investments can pay for your withdrawal every single year. If they can't, then you'll find yourself overspending because you need to. Right? Now, the rule of 4% says we can start off with withdrawing 4% of what you have saved and grow it with the cost of living every single year, as long as you're invested at least in a 60-40 stocks to bonds. And you won't run out of money within the next 35 years. And this means that you're broadly diversified in stocks to bonds, at least 60% stocks, 40% bonds. And you're not withdrawing over 4% adjusted for the cost of living every year. Now, this means by the time you're 80, you could be withdrawing 10% of what your nest egg is worth every single year. And it'll still last for an extra 15 years. Okay. So this 4% rule eventually gets up to 5, and then 6, and then 8, and then 10. So that's important to think about. Now, this typically confuses people. Anybody have any questions on how the 4% rule works? Everybody's keeping up? We got a smart crowd here today. Well done, everybody. All right. Now, the last piece is risk management tips. So, I've had clients in the past who have gotten in car crashes. I've had clients in the past who have had a porch pirate trip and fall and break their leg under their front doorstep. I've had clients who have been sued for a number of reasons. I've had clients who have rental properties. And rental properties have a lot of liability, and it's important to know how to protect yourself, because just imagine one lawsuit for $200,000 or $300,000 or $500,000 could legitimately ruin your retirement forever. And if there's a cheap way to eliminate that risk, then by all means do it, because you can afford to eliminate the risk. You can't afford to have to pay for it, right? Now, let's say, for example, you have a rental property. And somebody is on the front lawn of that rental property and trips and falls, and they have a great attorney and they prove that it's your fault. You were negligent. Well, now they sue you for $400,000 or $500,000 because they can't work now the rest of their lives. They're disabled, right? A lot of corrupt people in the world. We have to prepare for that. So how can we protect ourselves from this? Well, the first option is to purchase extra liability insurance. Now, when I say extra liability insurance, I mean if you've got a rental property, it'd be landlord's insurance. You'd have your liability coverage. Now, how much extra is the question? Well, it depends. If you own that property yourself, and depending on the state that you live in, because asset protection law differs by state, right? And what asset protection law is how much can someone sue you for? Can someone sue you for your retirement accounts, your non-retirement accounts? Can they sue you for all the rental properties? Can they sue you for equity in your primary residence and make you homeless? Some states, they can, right? California is a terrible state to get sued in, as well as a couple others, right? So when we're thinking about how much liability insurance you need, it depends on the state you live in. So typically the rule of thumb is, if you want to be extra conservative in retirement, it's your total net worth. And net worth is assets minus your liabilities. So if you had $2 million in retirement accounts and $100,000 in debt, your net worth would be 1.9 million, because 2 million minus 100,000 is 1.9. Right? That's how much liability insurance, that's the rule of thumb there, that you need, because that would be proving that you'd be bankrupt. Now, in some states, you might be able to get a lot less. Now, not all insurance companies are going to give you that much. Some insurance companies will say they want you to get an umbrella insurance policy. These are really, really inexpensive. They might only be $20 or $30 a month, maybe $100 on the high side, depending on how much you own and how much you're worth and what state you live in. So an umbrella liability policy is very common for most retirees, especially anyone who's saved well. Now, for a lot of people who own any rental properties, sometimes setting up an LLC, one LLC for each rental property, even though it's a pain in the butt come tax time, just have your tax guy take care of it. It'll help protect you and your personal liability for lawsuits if one of your tenants gets hurt. So by having a separate entity own each rental property, the benefit to you is if someone gets hurt on that property, they can only sue you for the value of that LLC, not all the rest of your money. So your rental property might only be worth $300,000 or $400,000. If they sued you for $1 million, well, you know, you've got liability coverage on that rental property. They can only sue you for $300,000 or $400,000. You know, they probably that protects you quite a bit better, right? Now the next one is be mindful of your actions. Now, I think this one is pretty obvious. We want to try to avoid things that could lead to a lawsuit, such as reckless driving, making defamatory comments. We want to try to avoid anything that could lead to a lawsuit in general. And this seems like it could be obvious, but there's a lot of things that people do that can put you at risk, right? Great example is just avoiding political protests in general. No matter what way you lean, let's avoid them, right? That could end up getting you in big trouble, right? Things to that effect. Whatever we can do to try to limit your liability, that would be better. Driving after dark even, that can be increasing your liability. And then lastly, try to retain assets in 401ks, IRAs, and pay off your mortgage early on. This is all really strong risk management strategies. 401ks have the power of the Employee Retirement Income Security Act's attorneys, ERISA, most powerful attorneys in the country. If someone sues you for the value of a 401k, it doesn't matter what asset protection law is. That's protected by the federal government. So keeping money in 401ks is a great way to protect yourself. Same thing with pensions. If you have a cash balance pension, leaving money in that is also protected by the same group. Most people don't have a pension anymore, but it's important to think about. Same thing with if an advisor recommends you to take the lump sum value from your pension. If you think you've got a lot of liability, probably not in your best interest. Probably a good idea to leave it in there, even though it could grow. You're about to retire, right? You don't need it to grow by investing it. And you think there's a risk that you could have getting sued, leave it in, right? Now, IRAs are protected by your state, but not every state. This is better than a non-retirement account, but not perfect in every state. Leaving money in an IRA or a Roth IRA, great way to protect yourself. And then lastly, paying off your mortgage early on. Most states protect equity in your primary residence because homeless is an issue. And if you're forced onto the streets as a retiree, needless to say, that's terrible. They don't want retirees be forced on the streets just because they got into a lawsuit. And paying off your home early on means you've got money in your house and it decreases your bills, which protects you from liability and takes your money from a non-retirement account, puts it in your home. As a result, you can't be sued for all of that. Now, what's all this worth? So when it comes to rebalancing your portfolio and investing it correctly, right? This is on average worth about 0.11%. If you work with a financial advisor or if you have an accountability partner, if your significant other, they help you stay on the straight and narrow, right? Just to help you make sure you stay disciplined to your budget. You don't buy and sell based on the movement of the stock market. That's worth on average 2.37% per year, right? On customized experience for family and wealth planning. When you work with a financial planner and it's more customized, just because of tax opportunities and helping you make a little more strategic moves once in a blue moon, that's on average worth 1.21%. And T is for tax smart planning and investing. If you work with your own CPA and you use tax loss harvesting and you're being conscious about how you're withdrawing money from different accounts, that's an average worth 1.22%. All in all, having a well-structured financial plan and you're being thoughtful and disciplined, this can improve your after-tax performance by 4.91%, right? So the value of financial advice or the value of just being thoughtful in your own financial plan, right? This is as per Russell Investments Value of an Advisor study. They do this every year. I don't like to make these salesy by any measure, but needless to say, people need financial planners. And if anybody's looking for a financial planning company that's non-commissioned, that's a fiduciary, that has over a decade of experience and has a whole team of people that can help you better plan for your future, because this is just the top 3. We have over 10 people that work with our clients. By all means, we're accepting clients right now. And like I said, we're experts at this. We've helped literally thousands of people reduce their tax bill, plan more thoughtfully for their retirements, and this transition into retirement. And invite anybody here if you're looking just for even just a complimentary consultation. We're happy to help out, and we won't be salesy. A couple things we do that I think is helpful: Medicare planning. Every single year would make sure you have the proper Medicare policies. Make sure your investment strategy makes sense given how much money you expect to withdraw from your account to help grow your money as fast as prudently possible. Would help you try to reduce your tax bill, not just today, but 5, 10, 20 years down the road, even once your life is over. Our goal would be to reduce your tax bill then too. And then lastly, comprehensive financial planning. That's just taking the guesswork out. Now, how it all works. So we'd gather your information, develop your plan, present your options to help you choose. And needless to say, we'll give you a recommendation of which option makes the most sense. This is your money, and we'll let you be in the driver's seat. We'll help you implement it to make things simple. And then we're going to monitor by meeting up with you regularly, as often as need be. Typically would require at least once every 6 months. But some people want to talk to us weekly. We're fine with that, right? And we'll help you pivot when it's appropriate. So don't leave your future up to chance. Talk to a fiduciary financial planner, someone who's legally and ethically bound to prioritize you over themselves. And needless to say, whether it be us or any other advisor, it's important, if you don't feel comfortable with the stuff, for you to just hire someone that you trust. Great place to look is napfa.org, or you can click on Talk to an Advisor on our website. We're happy to help you out as well. All right. So this is the conclusion of our presentation here today. I really hope this was valuable. I really hope everybody here got what they were hoping to out of this. And if you didn't already, I'm going to be here for the next 30 minutes to answer any extra questions people have. All right. I really appreciate it, everybody. I'm ready when you are. You're welcome, Helen. I'm happy I can help. SJ, I think you had a question earlier you wanted to talk to me about. Term life. All right. So term life can get pretty complicated. Do you want to unmute yourself and talk through this with me, or want me to just kind of talk about term life? There's a lot that can go into it. You're welcome. I'm happy this was helpful, everybody. Okay. I don't like salesy things. I just want it to be valuable. And end of the day, if people need help, you know who I am now. That's the idea. That's okay, SJ. So SJ, term life for retirees. Out of curiosity, what makes you interested in term life? What kind of things do you want it to pay for? Tell me a little more. Cover the education of your kids. All right. So you've got kids right now. So typically term life, the whole purpose of it is that you've got a period of time until you no longer need life insurance. I hate insurance in general. It's a necessary evil, but I hate it. And the whole reason behind term life is that, number one, if you passed away, your family couldn't afford it, right? So maybe if you're married, spouse may not be able to afford the home mortgage payment on their own. And on top of that, spouse probably couldn't afford to save for college for your kids, because that's really expensive, right? Today, it costs easily $80,000-$90,000 for an education, college education. So the whole idea behind it is, and the way that I've found makes the most sense for life insurance, is to figure out the least amount of life insurance we can get you, right? So great example is, if you have a mortgage for 20 years, you'd get one decreasing term 20-year life insurance policy, because every single year your mortgage is paid off a little more, a little more, a little more. And life insurance, the closer you get to that date, the less it'll pay out, just so it covers the payment of your home, pays the whole thing off, right? Least expensive way for you to cover that risk. When it comes to education, though, it gets a little different, because it depends on the school your kids want to go to and what kind of options you want to give them. I've had clients I have a client actually had just a baby just a couple months ago, and they bought term life insurance. We don't sell life insurance. We just give advice. That's all we're paid for. We're non-commissioned, right? We're not even licensed to sell life insurance. But to pay for college, they wanted to prepare their kid to go to Stanford or Harvard. And Stanford and Harvard today cost about $200,000 for a bachelor's degree, if not a little more. That's assuming no scholarships. And 20 years from now, you can imagine how much that's going to cost. A lot, right? If it grows at about 5% a year, 20 years from now, well, that means it'll probably cost closer to about $500,000 just for a bachelor's degree. So they bought a $500,000 term life insurance policy because they wanted to pay for the whole thing. 20 years, right? Not cheap. And in the meantime as well, they're saving pretty hard in a 529 in addition. And their goal is to get that 529 to be worth $500,000 before the term life insurance expires. Why? Because they really want to give that option to their kid and they can't afford to pay for it out of pocket right now. It is what it is, right? So the point of this all being is, in order to help you figure out how much term life you need, if you have 3 kids, you'd buy 3 different term life insurance policies. And you'd have to figure out what the future expected cost was going to be. Right? A great way to figure this out is there's actually a college calculator that'll forecast out the cost of college for you. And I'm going to put this in the chat as well, so that you can figure out how much life insurance to buy. Now, when you figure this out, don't just contact any old life insurance agent, because of course all life insurance agents can write term life, but contact an independent one. And the reason is, independent life insurance agents have access to every life insurance policy in the whole country. And as a result, they can find the least expensive one whose underwriting makes the most sense for you and your current health situation. Okay. I'm a big fan of, it's called First Element Insurance Planners. They're all non-commissioned insurance agents. The company itself is paid on commission. The insurance agents aren't. I refer all my clients to First Element Insurance. And I'm going to put this in the meeting here as well. I'm not paid anything for referrals to them. I'm just giving this because I think it's helpful. But it's a good idea to find an independent insurance agent and just have that work out through there. Now, Vanguard has a great calculator I'm putting in the chat right now. And I'm going to share my screen to show you a bit about how to use this. So let's say, for example, you have a 5-year-old and they have 13 years until college. So you'd say 13 years. And they're going to spend 4 years in college, and 5% is the average rate of cost increase in the United States. Let's say you want to send them to a state school, right? So it'd be $40,000 in the state of Colorado for most state schools. So as a result, well, today, $40,000, 13 years from now, 1 year of college is going to cost $75,000. Ouch. Actually, my mistake. 10,000 is how much it costs for state schools here. 13 years from now, it'll be 18,856. 4 years of college today, if they started immediately, they were 18 right now, it would cost 40 grand. 13 years, it'll cost 81,000. So for that one kid, you'd want to buy $81,000 in life insurance. minimum, but that's just for tuition. You have to add on other things like housing and food. But I think that'd be depending on your kid's lifestyle, what kind of goals they have, it would change for them. And so I'd recommend you use those two things I just put in the chat and do your research. This isn't advice. This is just saying, do your research, make sure you prepare for this conservatively. All right. Does that help out, SJ? That was a lot of information. Okay, great. So Anne, I saw that you had your hand up. Or Amy, my mistake. What can I do for you, Amy? You can unmute yourself if you want.
Oh, sorry.
Hello. Amy, are you looking for to ask me a question, or what can I do for you?
Well, I do have a question. Can you hear me?
Yes, ma'am.
The one thing that I'm wondering about is how would I go about figuring out my ex-spouse's amount of Social Security that could help me when I retire?
Your ex-spouse. So are you divorced? Did he pass away? Tell me a little more.
Divorced. We were married 14 years.
Okay. So typically what you'd do is you'd call the Social Security Administration. You have to have your divorce decree. Do you still have your divorce decree out of curiosity in some file folder somewhere?
I think so.
Okay. So you'd have to have your divorce decree in hand. If you don't, you have to contact the Office of Vital Records, I believe, and they can get that for you. But once you have that in hand, you can contact Social Security and say, hey, my ex-spouse is collecting Social Security right now.
They have to be collecting Social Security?
Mm-hmm.
Okay.
Yeah, you have to wait till he's collecting. You can't file before that. But if you contact them once he's collecting, you just can collect based on his earnings record.
Well, how do I know that? How would I know that?
That's the tough question. You have to contact him once a year, I guess. How old is your ex-spouse right now?
Well, he just turned 65.
Okay. Contact him right now if you want. Are you?
He's not collecting it now for sure. I just
Okay.
wondered how that worked.
I'm
not collecting Social Security either. I'm just wondering how that system works.
They won't tell you when he's collecting because it's personal information, unfortunately. So it's kind of a pain. You have to call him and prove the divorce decree and make sure you give them your social, and they'll be able to pull up that information for you. But you'll have to contact them once a year. They're not going to notify you. Most people wait until they reach their full retirement age before collecting on their ex-spouses, just because you get a lot more, right? So
yeah,
I mean,
what I understand is if mine would be like $2,800 if at full retirement per month. That means his would have to be more than $5,600 for me to even benefit from it, right?
Not a single person gets over 5,600 in Social Security. So even
if I'm getting 2,800 at full retirement, then that's probably all I'll get.
I mean, if you started collecting on his earnings record right now over the next 12 months, were you born before 1960? If you want to say I don't want to answer, that's perfectly fine.
Yes, I was.
Okay. All right. So if you started claiming his benefit right now, let's just say hypothetically, he's claiming right now too, it would actually decrease your full retirement benefit by a little bit because you filed early, even if it's for an ex-spouse's benefit.
I wouldn't file till I'm 66 in 6 months. So that will be a year from now.
Okay. Most people in your scenario would just probably forego the whole spousal benefit, unfortunately.
That's what I was thinking that I should do because it's not enough to make a big difference.
Not at all.
So what is the maximum Social Security people can get?
If you made over 130,000 for 35 years straight and you filed at 70, I believe it's 4,600 a month right now.
Oh, well, then I can forget that because, he hasn't made that much. I mean, he did make like 150,000 a year for several years, but I mean, that wasn't 35 years in a row. No.
Not many people make that much for 35 years straight.
No. So maximum people get is like 4,800.
I think it's 4,600 right now. I don't know the exact number off the top of my head, but it's roughly right around there.
So I should just wait till I'm 66 in 6 months, or even 70, and just forget about it.
And somewhere between those two is probably a good idea, unless you're really hard up for cash and need it immediately. Typically waiting longer will get you more, as long as you live past the age of like 82. So
You can wait till you're 82.
no, wait until you're 70 to file, as
Yeah.
opposed to full retirement age. Typically by waiting until you're 70, you're going to get a lot more. So when you turn 82 is when the two break even.
I think it said if I wait till I'm 70, I would get like 3,400 a month.
Mm-hmm.
So I think I'll do that.
I mean, hey, if you don't need the money, push it back. It just means you'll get a lot more and you won't have to take so much out of investments.
Well, I plan to probably work until I'm 70.
Okay.
That's my game plan.
You like doing what you do?
Yeah.
Makes sense.
I'm a pharmacist, so I just kind of work part-time now.
I haven't talked to many pharmacists in my career that say that they don't like doing what they do. It can get a little stressful because of liability, I've heard, but that's about the only downside. Correct me if I'm wrong there.
Yeah, no, it sometimes gets stressful, but I've been doing it for 40 years. And so I haven't ran into anything that I haven't seen. So it's all, pretty much easy, because I've already experienced everything that on a day-to-day basis. I've seen it all, in other words. I know what to expect.
You've liked it.
Hmm?
I'm happy you've enjoyed your career. Not everybody
Yeah,
can say that. That's really wonderful.
I think something that I really enjoy. So
Yeah. Well, makes
I
sense.
really don't want to quit. It's just I know that eventually I need to.
Well, if you eventually need to, by all means, but I have heard of a couple people when they do quit a career they love, sometimes they want to go and teach it part-time at a university or something. You ever thought
Yeah.
about that, or does that not sound like your speed?
Well, no, I don't think I'd want to do that, but I think that I would enjoy maybe working, just tapering off until I work maybe like 6 or 8 days a month or something like that.
Yeah, I can see that. Makes sense to me. 6 or 8 days doesn't sound too stressful at all. Yeah.
No, just something to keep you in the program with your work field, and just to keep you going and moving.
Yeah. I've heard that people who retire early, they typically don't have as long of a retirement, right? Retiring early doesn't get you more retirement. It just moves the goalposts a little bit. So
Yeah.
scary stuff.
Mhm. Well,
So,
anyway, thank you so much. I really enjoyed this. It was very informative
I'm
and
glad.
interesting. I didn't fall asleep or anything. You kept my interest.
I try to make things colorful without making them unprofessional. That's my goal. So
Yeah, and 1 hour was the perfect length of time.
I'm really glad. Well, in the future, if you want to talk to me at all, I don't charge for appointments, and I'm not salesy, as you know. Just answer your questions. Needless to say, I'm building my practice. My practice is a little over 2.5 years old now. Got 68 households, so it's not a tiny little practice either.
So
But
where are you located?
I'm in Denver. Mhm.
Oh, wow.
Yeah.
I'm all the way here in Florida.
Oh, wow. I like it. Hey, it's nice this internet's bringing everyone together.
Mhm. Yeah.
Yeah.
Okay.
Yeah.
Well, thanks again, and I really enjoyed it. So have a nice Saturday.
You too. And if I don't talk to you again, congratulations on retirement when you retire.
Okay.
All
Thank
right.
you.
You have a great day. Nice talking with you. All right. So Jeremy, I see you're in here still, and SJ. Anything else I can do for you two? All right. Well, I'll send everybody an email after this. I hope everyone has a good day, and I'm glad this was helpful. Thanks, everybody.
Thanks.